Imagine sitting at the edge of a market that never sleeps, where a single number can rewrite the rules of wealth. For legendary investor Stanley Druckenmiller, 1000 isn't just a milestone, it's a psychological tipping point that transforms how investors think, act, and react. In his signature way, Druckenmiller strips away the noise, revealing the raw truths about money, risk, and human behavior that most people ignore until it's too late. Understanding this shift isn't just about watching numbers move. It's about grasping the forces that quietly dictate the rise and fall of fortunes, and why everything in finance looks different once the critical threshold is crossed. For Stanley Druckenmiller, the figure 20,000 represents far more than just a sum in a bank account or a benchmark on a trading screen. It is a psychological milestone, a threshold at which the way investors perceive markets, opportunities, and risks undergoes a profound transformation. Before reaching this number, many individuals treat financial decisions with a certain casualness, often guided more by instinct, hearsay, or superficial trends than by rigorous analysis. The smaller sums encourage a mindset that is reactive rather than proactive, focused on the immediate potential for gain or loss rather than the broader implications of each move. People may be willing to gamble, to take chances without fully weighing the consequences, because the perceived stakes are relatively low. The journey to $20,000, however, begins to shift that dynamic. Suddenly, the stakes feel higher, not just because of the amount itself, but because of the psychological significance attached to it. That number signals a transition from casual investing to serious financial engagement, where every decision carries more weight and demands a more disciplined approach. Druckenmiller often emphasizes that reaching 20,000 or any comparable threshold forces a person to confront their own biases and limitations. Below that level, it is easier to shrug off losses, chalk them up to experience, and move on without much introspection. The emotional cost is minimal, and the lessons learned are often theoretical rather than practical. Once that critical sum is approached, however, losses start to sting more deeply, and the consequences of misjudgment become far more tangible. It is at this stage that many investors begin to realize that successful money management is not just about finding opportunities, but about understanding oneself. The fear of loss and the desire to protect gains suddenly become more acute, prompting a shift in behavior that is both natural and necessary. Druckenmiller has pointed out that this is where the journey from amateur to professional thinking begins, where the casual attitudes of the past must give way to a structured, strategic mindset capable of navigating the complexities of real financial markets. Part of the transformation at this milestone involves a heightened awareness of risk. When amounts are small, risk is often assessed superficially, with investors either underestimating or overestimating potential consequences. Decisions are influenced more by short-term swings and by the opinions of others than by a careful calculation of probabilities and outcomes. Reaching 20,000, however, forces a person to start thinking in terms of real exposure and probability, to recognize that each action carries measurable consequences that can compound over time. Druckenmiller underscores that this is a turning point where intuition must be tempered by analysis. The thrill of opportunity is still present, but it must now coexist with the dismal downside scenarios, margin of safety, and risk-reward balance. The shift is subtle but profound. A trader or investor begins to see the market not just as a source of potential profit, but as a complex ecosystem where decisions reverberate across time and circumstance. The psychological impact of reaching 28,000 also extends to decision-making under pressure. Druckenmiller describes the early stages of wealth accumulation as a period when choices are often impulsive or opportunistic. Smaller sums allow for trial and error without significant consequence, encouraging a reactive style where emotions can dictate actions. Crossing the 20,000 mark changes the game because losses now carry tangible weight and gains feel more substantial in their implications. The mind, conditioned to think in terms of small, easily recoverable amounts, must recalibrate to consider the long-term effects of each move. Investors begin to recognize that patience, timing, and strategic foresight are not optional, they are essential. Each trade, each allocation decision is now a test of discipline and of the ability to control impulses. The psychological pressure forces a refinement of both technique and temperament, honing skills that previously existed in theory but not in practice. Druckenmiller also notes that this threshold can act as a catalyst for self-reflection and personal growth. Achieving 20,000 prompts a critical examination of habits, biases, and emotional triggers. Investors are forced to ask themselves why they make certain choices, what motivates their reactions to market movements, and how their mindset might limit their potential. The realization that money is not just a number but a reflection of behavior and decision-making philosophy can be both humbling and empowering. It signals the beginning of a more conscious, deliberate approach to investing, one that values preparation, insight, and adaptability over raw luck or instinctive reaction. In essence, the 20,000 milestone becomes a mirror, reflecting both the opportunities available and the personal challenges that must be addressed to navigate them successfully. This transformation is further amplified by the social and perceptual shifts that occur at this level. Investors notice that with increased capital comes increased scrutiny, whether from peers, advisors, or the broader market. Decisions are no longer made in a vacuum, and the potential consequences of missteps are magnified. Druckenmiller observes that this social dimension can intensify the psychological impact, compelling individuals to adopt a more thoughtful, measured approach. The awareness that money carries not only personal implications but also reputational and relational consequences encourages more careful analysis, deeper research, and a willingness to challenge one's assumptions. The journey to 20,000 is therefore as much about mastering oneself as it is about mastering markets, signaling a turning point where emotional intelligence, strategic thinking, and risk management converge to shape the next stage of financial growth. This milestone is also an invitation to develop a framework for decision-making that can sustain continued success. Before reaching this level, choices are often guided by anecdote, trend, following, or trial and error. After reaching it, the need for a structured methodology becomes apparent. Druckenmiller's approach emphasizes the importance of learning from past outcomes, adapting strategies to changing conditions, and maintaining discipline even in the face of opportunity or fear. Investors begin to understand that wealth is not merely accumulated through luck or timing, but through deliberate, informed actions guided by a clear understanding of risk and reward. The 20,000 mark is thus a turning point where the abstract principles of investing are tested in practice, and where the lessons learned carry both tangible and psychological weight that influence all subsequent decisions. Once investors cross the 20,000 threshold, the way they perceive risk undergoes a profound metamorphosis. Before reaching this point, risk often feels abstract, a concept discussed in books or taught in classrooms, but rarely experienced with true consequence. Losses are easier to absorb, mistakes are easily rationalized, and the emotional cost of failure is relatively low. This fosters a mindset that can lean toward recklessness or impulsivity, where decisions are guided more by hope or fear of missing out than by disciplined calculation. Druckenmiller has often highlighted that the human brain reacts differently when real stakes are at play. The weight of potential gain is no longer the dominant force. The potential for loss becomes just as, if not more, powerful. Crossing 20,000 is where the theoretical understanding of risk transforms into a visceral experience, one that forces investors to reconcile emotion with strategy. The casual experiments and speculative gambles of earlier phases give way to a careful evaluation of what can be lost and what must be preserved, demanding a mindset attuned to both opportunity and protection. The change in risk perception is not merely about fear, it's about clarity and precision. Druckenmiller emphasizes that the investor who has reached this milestone starts to see risk as quantifiable and manageable rather than unpredictable and frightening. Each decision is scrutinized, probabilities are calculated more rigorously, and potential outcomes are assessed with a critical eye. This does not eliminate uncertainty, It never can, but it frames uncertainty in a context that can be understood and addressed. The investor begins to consider worst-case scenarios and test their assumptions, recognizing that markets are fluid and conditions can shift with little warning. The knowledge that a single misstep could have substantial consequences transforms the approach from reactive to proactive. Decisions are no longer made in the heat of excitement or panic. They are evaluated through a lens of strategy, discipline, and foresight. Psychology plays an enormous role in this shift. Before reaching 20,000, many investors rely on intuition and impulse, believing that confidence alone is sufficient to navigate the market. Emotions like greed, envy, and overconfidence often drive decisions, sometimes yielding short-term gains but at the risk of long-term instability. Druckenmiller points out that the transition to higher stakes forces a recalibration of these impulses. The awareness that losses now carry real consequences sharpens mental focus and heightens emotional discipline. Investors become acutely conscious of their behavioral tendencies, recognizing when fear or euphoria is influencing their judgments. This self-awareness is crucial because it allows for interventions, rules, strategies, or even pauses in trading that protect against irrational choices. The maturation of emotional intelligence at this stage is as important as technical skill, shaping not just what decisions are made, but how they are made. Another dimension of risk perception that evolves is the understanding of compounding. Below $20, and the power of compounding may seem like a distant, abstract concept, but once this threshold is crossed, investors experience it firsthand. Gains and losses start to feel exponentially more significant, and the cumulative effect of repeated decisions becomes impossible to ignore. Druckenmiller often underscores that recognizing the long-term impact of each choice is transformative. Every trade, every allocation, every adjustment in strategy begins to carry far-reaching consequences that influence future potential. This awareness encourages prudence, patience, and a strategic mindset that balances ambition with caution. Investors learn that compounding works not just in favor of wealth accumulation, but also against them if risk is mismanaged, creating a heightened sensitivity to both opportunity and danger. At the 20,000 level, risk assessment also becomes more holistic, incorporating external factors that previously might have been overlooked. Investors begin to consider macroeconomic trends, geopolitical events, and market sentiment as integral components of their strategy. Druckenmiller stresses that high-stakes investing cannot rely solely on technical analysis or historical patterns. It requires an understanding of the broader forces shaping market behavior. The psychological shift involves acknowledging that control is limited and uncertainty is inherent, but that thoughtful preparation and adaptive strategies can mitigate exposure. This broader perspective transforms risk from a singular, personal consideration into a multidimensional framework that encompasses timing, positioning, and context. The perception of risk also changes in relation to opportunity. Before reaching this milestone, opportunities often feel abundant and low stakes, leading investors to chase trends with little regard for downside. After 20,000, the thrill of opportunity remains, but it is tempered by a conscious evaluation of what is at stake. Druckenmiller highlights that this balance between ambition and caution is where skill differentiates successful investors from those who falter. The excitement of a potential gain must be weighed against the consequences of potential loss, and decisions are filtered through a lens of probability, risk tolerance, and strategic foresight. Finally, this new approach to risk is characterized by discipline and adaptability. Investors at this stage recognize that markets are dynamic, conditions shift, and yesterday's strategies may not suffice today. The experience of managing larger stakes reinforces the importance of maintaining flexibility, adjusting positions, and avoiding rigidity. Druckenmiller has often described this as the difference between surviving and thriving. Those who master the psychological shift in risk perception after 20,000 are equipped to navigate volatility, capitalize on opportunity, and protect their gains in ways that were not possible before the milestone. With the transformation in risk perception firmly in place, The next critical factor that Stanley Druckenmiller emphasizes is the approach to capital allocation and timing. Reaching 20,000 is not simply about holding a certain sum of money. It is about the realization that every dollar must be strategically positioned to optimize growth while minimizing vulnerability. Prior to this threshold, investors often allocate funds in a haphazard or opportunistic manner, driven by tips, trends, or instinct rather than analysis. The stakes feel low enough that mistakes are tolerable, and the urgency to plan meticulously is minimal. Once that milestone is achieved, however, the mindset shifts entirely. The focus turns to precision, deciding not only what to invest in, but when to commit, how much to allocate, and when to step back. Druckenmiller describes this as a dance between patience and decisiveness, where success hinges on the ability to recognize both opportunity and timing with clarity and confidence. Capital allocation at this level requires a disciplined framework. Investors begin to understand that spreading money indiscriminately across assets dilutes potential gains and increases exposure to unnecessary risks. Druckenmiller has often noted that concentration, when guided by insight and conviction, can be far more powerful than diversification pursued without thought. The challenge lies in knowing where to concentrate resources without succumbing to overconfidence or emotional bias. Each decision demands rigorous evaluation of fundamentals, market conditions, and the probability of success. Timing, in particular, becomes a crucial factor. The same opportunity can yield dramatically different outcomes depending on when capital is deployed. Investors learn that patience is not passive, is an active strategy of waiting for the right setup, observing market behavior, and positioning decisively when conditions align. The psychological shift in capital allocation is intertwined with the lessons learned about risk. Before crossing the 20,000 threshold, the potential for loss is perceived as manageable, and investments are often made with a willingness to absorb errors. Beyond that point, the stakes are real, and losses carry tangible weight. Druckenmiller emphasizes that this realization forces investors to approach allocation with both ambition and caution. It is no longer sufficient to chase returns blindly. Each allocation must account for potential downside, volatility, and the likelihood of success. The mental discipline required to balance these factors is substantial, demanding not only analytical skill, but also emotional control. Investors must resist the temptation to overact to short-term fluctuations, instead maintaining a strategic perspective grounded in careful assessment and foresight. Timing, in Druckenmiller's view, is often the differentiator between profitable allocation and missed opportunity. Markets are inherently cyclical, influenced by economic trends, investor sentiment, and global events. Investors who reach the 20,000 milestone gain a heightened appreciation for the ebb and flow of these cycles, recognizing that entry points and exit strategies can dramatically impact outcomes. The discipline of timing requires patience, research, and a willingness to act decisively when the window opens. Druckenmiller likens this to being a hunter rather than a collector. The goal is not to grab everything in sight, but to strike when conditions are optimal. This approach demands not only skill and preparation, but also self-restraint, as acting prematurely or hesitating too long can erode the potential for success. Capital allocation also evolves in its strategic sophistication. Before this threshold, decisions are often reactive, responding to immediate market movements or anecdotal cues. Beyond 20,000, allocation becomes proactive, guided by a combination of market analysis, trend recognition, and scenario planning. Druckenmiller stresses that this is where experience and intuition intersect with disciplined strategy. Investors begin to anticipate shifts, hedge positions, and structure portfolios with both offense and defense in mind. The ability to allocate dynamically, adjusting exposure based on evolving conditions, is a hallmark of those who thrive in high-stakes environments. Another key aspect is the reallocation and compounding. With more substantial sums at play, the impact of each decision is magnified. Successful allocations can accelerate growth exponentially, while missteps can erode capital at an alarming pace. Druckenmiller highlights that understanding the compounding effect is not just a matter of mathematics. It is a psychological awareness that informs every move. Each allocation is evaluated not just on immediate potential, but on its contribution to long-term growth and resilience. This mindset reinforces prudence, prioritization, and strategic foresight, ensuring that money is deployed where it can achieve the most significant impact without exposing the investor to undue risk. The refinement of allocation and timing also involves learning from outcomes, both positive and negative. Investors who have crossed the 20,000 threshold are confronted with the consequences of prior decisions more starkly than before. Gains and losses are felt more acutely, providing immediate feedback that sharpens judgment. Druckenmiller emphasizes the importance of reflection and adaptation, studying what worked, what failed, and why, then using that knowledge to refine future decisions. This iterative process turns experience into actionable insight, allowing investors to continually improve their allocation strategies and timing precision. Finally, Druckenmiller underlines that mastering allocation and timing is not a static achievement but a continuous process. Markets evolve, opportunities emerge and disappear, and conditions change unpredictably. Investors must remain alert, adaptable, and disciplined, integrating the lessons learned allocations into a dynamic strategy that balances risk, reward, and timing. The 20,000 milestone is thus a gateway to a higher level of financial acumen, where capital is managed not just as money, but as a tool for strategic advantage, and timing becomes a weapon in the pursuit of lasting success. As investors refine their capital allocation and timing, Stanley Druckenmiller emphasizes that market sentiment becomes an increasingly powerful force shaping outcomes. Crossing the 20,000 threshold brings more than just greater stakes. It brings an acute awareness that markets are driven not only by fundamentals, but by the collective psychology of participants. Before reaching this milestone, many investors may focus narrowly on numbers, charts, or individual opportunities, often underestimating the influence of mood, perception, and crowd behavior. Druckenmiller has repeatedly pointed out that sentiment can amplify trends, create momentum, and sometimes override logic in ways that are both thrilling and dangerous. Understanding this dynamic is essential because even the most precise allocation and perfect timing can be undermined if market sentiment moves against an investor. Recognizing the interplay between rational analysis and emotional forces becomes a cornerstone of high-level investing. Market sentiment, Druckenmiller explains, is fluid and often unpredictable. Investors who have not yet experienced hierarchies may perceive the market as a rational arena where opportunities are determined purely by numbers, earnings reports, and economic indicators. Beyond 20,000, however, it becomes clear that the collective mood of traders, investors, and institutions can drive prices in ways that defy traditional logic. Fear can spread like wildfire, triggering sell-offs even when fundamentals remain strong, while euphoria can push prices to irrational highs. Those who have accumulated more substantial capital quickly learn that understanding these emotional currents is just as critical as understanding financial statements or technical charts. The ability to sense, anticipate, and even capitalize on sentiment shifts can differentiate those who thrive from those who falter. Druckenmiller often stresses that successful investors are not just analysts, they are psychologists in their own right. Observing market sentiment involves more than tracking news headlines or social media chatter. It requires an intuitive understanding of collective behavior, a sense of how optimism and pessimism build and fade, and a recognition of when the crowd is leaning too far in one direction. The investor who masters this skill can position themselves advantageously, buying when fear dominates and selling when greed overwhelms. This approach is not reckless contrarianism. It is disciplined observation paired with strategic action. By respecting the power of sentiment, investors can make moves that align with broader trends rather than being swept along by them. Sentiment also influences the timing of decisions, which Druckenmiller has identified as a critical element of success. No matter how well capital is allocated or how thoroughly risk is assessed, acting out of sync with prevailing sentiment can magnify losses or reduce gains. Crossing 20,000 Thousand highlights the necessity of reading the mood of the market as carefully as the fundamentals. A strong opportunity can falter if sentiment is negative, while a modest opportunity can flourish if optimism runs high. The ability to gauge this invisible force becomes a skill honed through experience, observation, and reflection. Investors begin to notice patterns, the subtle signals that precede a swing, the tipping points where fear or greed dominate, and the moments when intervention or patience is required. This understanding transforms trading from a purely analytical exercise into a nuanced interplay between data, psychology, and timing. Druckenmiller also notes that sentiment can amplify the psychological pressures already intensified by crossing the 20,000 mark. Investors are now acutely aware that losses and gains carry real consequences, which can heighten reactions to market mood swings. Fear of missing out can become more pronounced during bullish phases, while anxiety can intensify during downturns. The challenge lies in maintaining discipline while remaining responsive to sentiment signals. Those who succeed learn to navigate these emotional currents without being swept away, balancing awareness with rationality. They recognize that sentiment is neither inherently good nor bad. It is a tool to observe, interpret, and leverage strategically. Another critical aspect is how sentiment interacts with liquidity and market structure. Druckenmiller highlights that high-stakes investing exposes individuals to forces beyond their control. Large institutional flows, algorithmic trading, and sudden shifts in capital movement can all be driven by collective sentiment. Understanding these dynamics is essential for protecting capital and seizing opportunities. Investors begin to appreciate that sentiment is not just about headlines or crowd psychology. It manifests in tangible price movements, volume surges, and volatility spikes. The ability to read these signals and act decisively becomes a defining skill, turning observation into actionable insight that can magnify returns or shield against losses. Sentiment also encourages adaptability and flexibility. Investors who have crossed the 20,000 threshold learn that rigid strategies fail when emotions dominate the market. Druckenmiller emphasizes that reading sentiment requires openness, the willingness to change course, to exit positions early, or to embrace opportunities that others overlook. By combining technical and fundamental analysis with an awareness of the emotional climate, investors can position themselves for asymmetric outcomes, maximizing gains when sentiment aligns with their strategy and minimizing losses when it does not. The interplay between psychology and market mechanics becomes a dynamic environment in which agility, timing, and perception define success. Finally, understanding market sentiment reinforces the broader lesson that investing at higher stakes is as much about observation and intuition as it is about calculation. Druckenmiller's insight is that the 20,000 threshold not only elevates the scale of investments, but also amplifies the complexity of the environment in which decisions are made. Investors learn that numbers tell part of the story, but the collective mood of the market often writes the next chapter. Mastering this element requires attentiveness, reflection, and the courage to act in harmony with both logic and the emotional undercurrents that define every market move. As market sentiment becomes a guiding force, Stanley Druckenmiller underscores the paramount importance of flexibility and adaptability in investing. Reaching the 20,000 milestone does more than amplify stakes or sharpen risk awareness. It exposes investors to the relentless reality that conditions are never static and that rigidity can be fatal. Before crossing this threshold, many individuals approach markets with fixed ideas, relying on static strategies, rules they have memorized, or patterns they have seen succeed in the past. At smaller sums, inflexibility may go unnoticed because the consequences of error are minor. Beyond 20,000, however, every misstep carries weight, and the inability to adjust strategies in response to shifting circumstances can quickly erode gains or magnify losses. Druckenmiller emphasizes that true investing mastery lies not in stubborn adherence to past methods, but in the ability to pivot, rethink, and recalibrate in real time, aligning actions with the evolving market landscape. Flexibility begins with mindset. Investors at this stage must accept that uncertainty is a permanent feature of markets, not an anomaly. The market will always present scenarios that defy expectations, and no amount of analysis can guarantee certainty. Druckenmiller highlights that embracing this reality is critical. The most successful investors do not seek to eliminate uncertainty. They learn to operate effectively within it. This requires mental agility, the capacity to question assumptions, and the willingness to revise strategies when new information or changing conditions demand it. Flexibility is therefore not a passive trait, but an active, dynamic skill that allows the investor to remain aligned with opportunity while managing exposure to risk. One of the first lessons in adaptabilizing when a strategy has outlived its usefulness. Before $20, investors may stick with familiar tactics even when evidence suggests a shift is necessary, relying on hope or past success to justify continued application. Crossing the threshold reveals the limitations of such thinking. Druckenmiller observes that markets are constantly evolving. Macro trends, sentiment swings, technological shifts, and policy changes all influence outcomes. What worked yesterday may underperform tomorrow. Investors who thrive learn to identify these inflection points quickly, making adjustments with precision rather than waiting until failure is unavoidable. Adaptability, in this sense, becomes a form of survival, ensuring that strategies remain effective even as the market's rhythm changes. Flexibility also extends to timing and positioning. Druckenmiller emphasizes that no plan should be so rigid that it cannot respond to new signals. Investors at this stage develop a keen sense of when to accelerate action, when to pause, and when to reallocate resources. This requires both discipline and intuition. Discipline ensures that adjustments are made for rational, evidence-based reasons rather than impulsive emotion, while intuition, refined through experience, allows for rapid interpretation of subtle market cues. The combination of these qualities transforms adaptability from a theoretical concept into an actionable, high-stakes advantage. The psychological aspect of adaptability is equally critical. Crossing the 20,000 milestone magnifies emotional responses to gains and losses. Investors must reconcile excitement, fear, and the urge for control with a willingness to change course when conditions demand it. Druckenmiller emphasizes that flexibility is often hindered not by lack of knowledge, but by ego or attachment to prior decisions. The ability to set aside pride, admit error, and embrace change is a hallmark of successful high-stakes investing. Those who cling rigidly to outdated strategies risk amplifying losses, while those willing to pivot harness the power of opportunity as it emerges. Adaptability also involves learning to anticipate change rather than simply reacting to it. Druckenmiller points out that investors who master this skill can identify early signals of market shifts, whether in sentiment, liquidity, or macroeconomic trends, and adjust their positions proactively. This anticipatory approach requires careful observation, disciplined research, and the confidence to act before the majority does. The thrill of investing at higher stakes lies in this ability to navigate uncertainty with foresight, capturing asymmetric opportunities that remain invisible to those mired in rigid thinking. Another facet of flexibility is the willingness to experiment within controlled parameters. Before the 20,000 threshold, experimentation may occur haphazardly, guided by curiosity or imitation. Beyond it, Druckenmiller suggests that calculated experimentation becomes a tool for refinement and optimization. Investors can test strategies, explore new instruments, or adjust allocations while maintaining safeguards that limit downside risk. This balance between creativity and caution ensures that innovation fuels growth without exposing capital unnecessarily. Druckenmiller also notes that adaptability is relational. It affects how investors interact with advisors, partners, and the market itself. Being flexible allows one to incorporate diverse perspectives, adjust to changing conditions and institutional flows, and respond to shifts in broader market dynamics. It is a quality that transforms investing from a rigid set of rules into a dynamic, responsive practice where observation, learning, and action continuously reinforce one another. Finally, flexibility reinforces resilience. Markets are unpredictable, and high-stakes investing inevitably involves setbacks. Druckenmiller emphasizes that those who adapt quickly recover faster. preserve capital, and capitalize on new opportunities. The 20,000 milestone magnifies the consequences of rigidity, but also magnifies the rewards of adaptability, creating a feedback loop where flexibility not only protects wealth but multiplies its potential as flexibility and adaptability become ingrained. Stanley Druckenmiller turns the focus to the ultimate lesson of crossing the 20,000 threshold, preserving and growing wealth in volatile markets. At this stage, investors are no longer merely participants in the market, they are stewards of capital whose decisions carry meaningful consequences. The stakes are high, and the environment is unpredictable, with opportunities and risks intertwined in every fluctuation. Before reaching this level, many investors prioritize short-term gains, chasing trends or reacting impulsively to price movements. Beyond 20,000, the calculus changes entirely. Preservation of capital becomes as critical as the pursuit of growth, and success depends on balancing ambition with caution, strategy with patience, and insight with discipline. Druckenmiller emphasizes that wealth management at this level is both an art and a science, demanding a holistic understanding of risk, timing, market psychology, and personal behavior. The first principle of preserving wealth in volatile markets is understanding that risk is never eliminated, it is only managed. Investors below 20,000 may treat risk superficially, often assuming that luck or intuition can compensate for lack of strategy. Crossing the milestone sharpens awareness that every position carries potential for gain or loss, and that miscalculations are magnified by larger capital. Druckenmiller has repeatedly highlighted that this awareness transforms the mindset from reactive to proactive. Investors begin to actively evaluate down scenarios, set realistic limits, and prepare contingency plans. Protecting capital is no longer a passive hope, it becomes a deliberate strategy that governs decisions, ensuring that exposure is calibrated to the individual's risk tolerance and market conditions. Druckenmiller also emphasizes that growth in volatile markets is inseparable from preservation. Aggressive strategies, without regard for protection, may generate short-term excitement, but they leave investors vulnerable to catastrophic losses. Conversely, overly conservative approaches may safeguard capital, but fail to capture meaningful returns. The challenge lies in striking a balance, deploying capital to seize opportunities while maintaining safeguards that mitigate the impact of adverse movements. This requires a sophisticated understanding of volatility correlations and the dynamics of financial instruments. Investors learn to recognize when to press for gains and when to retreat, adjusting positions as conditions evolve. The 20,000 threshold highlights that mastery is not simply about chasing returns, it is about strategically growing wealth while protecting it from the unpredictable currents of the market. Timing plays a crucial role in both preservation and growth. Druckenmiller points out that markets are not linear, and volatility often creates risk and opportunity simultaneously. Investors must develop the ability to discern when to act, when to wait, and when to exit. Reacting too quickly to temporary fluctuations can erode gains, while hesitation in the face of emerging trends can result in missed opportunities. By learning to read the market with precision, evaluating both sentiment and fundamentals, investors position themselves to capitalize on favorable conditions while avoiding pitfalls. This dynamic approach requires a constant interplay between observation, analysis, and disciplined action. Emotional control is another critical element of managing wealth in volatile markets. The 20,000 milestone intensifies the emotional stakes, amplifying the psychological impact of gains and losses. Druckenmiller emphasizes that successful investors develop the capacity to remain calm under pressure, to resist impulsive decisions, and to maintain a strategic perspective even during periods of extreme turbulence. Emotional discipline ensures that reactions are informed rather than reflexive, allowing investors to stick to well-considered plans and avoid being swept away by fear or euphoria. This psychological resilience is a key differentiator, separating those who endure market volatility from those who falter. Druckenmiller also highlights the importance of allocation as a tool for both preservation and growth. Beyond 20,000, investors recognize that no single asset or strategy can guarantee success. Carefully constructing a portfolio that spreads exposure across different instruments, sectors, and regions reduces vulnerability while preserving upside potential. Diversification is not about avoiding risk entirely. It is about managing exposure intelligently, ensuring that individual losses do not imperil overall wealth. This strategic allocation requires both technical analysis and a deep understanding of how different elements interact under varying market conditions. Another dimension of preserving and growing wealth is learning from experience. Investors who have crossed the 20,000 threshold are exposed to both amplified successes and failures. Each decision, each outcome serves as a lesson in managing risk, reading sentiment, and timing action. Druckenmiller stresses that reviewing past decisions, identifying errors, and refining strategies are essential for continuous improvement. This iterative process turns experience into actionable insight, enabling investors to adapt to changing market dynamics while steadily increasing their proficiency in capital management. Liquidity management also becomes a central concern. In volatile markets, the ability to deploy or withdraw capital efficiently can mean the difference between seizing opportunity and suffering loss. Druckenmiller points out that preserving flexibility in access to funds is as important as choosing the right investments. Investors learn to maintain reserves, stagger commitments, and structure portfolios to allow rapid adjustments when conditions demand. This combination of adaptability ensures that capital remains both protected and poised to grow. Finally, Druckenmiller emphasizes that mastering wealth preservation and growth requires a mindset that integrates discipline, observation, and foresight. Beyond 20s, Alisters recognized that success is not measured by short-term gains alone, but by sustained performance over time. Every allocation, every adjustment, and every decision contributes to a trajectory that balances opportunity with caution. The journey transforms investing into a strategic, high-stakes endeavor where mastery of markets, psychology, and timing converge to create lasting wealth.